Go. Okay. Well, welcome to the 401k Investment Club. I have Jeff Braden and Austin Schellhammer, the 401kinvestmentclub.com. We put this together with our community to not only inspire, educate, and provide opportunities to our club, but to have fun as well. Gentlemen, Jeff, can you say a little bit about yourself? How long you've been investing?
Yeah, I've been investing in 2008. Started off in single-family homes, turned them into rentals, went into wholesaling for a while and succeeded in that. And now I am jumping into multifamily and getting into that.
Fantastic. Austin, can you tell a little bit about yourself and how long you've been investing?
Yeah, definitely really excited to be here, Todd. I've been investing for about 5 years, done about 65 successful deals, fix and flips, mainly focused on Denver, Colorado Springs, Pueblo area in Denver, but we also are up in Aspen, Snowmass, Grand Junction, and also out of state. I've managed a lot of funds for investors, and yeah, I just finished up my Denver portfolio, and I'm starting to focus on multifamily value add and also the mountain resort towns.
Fantastic. Well, I know coming into this marketplace where it is now, as multifamily is becoming a target, while the margins on single family are getting thin, if not too lean to work with. So welcome to the 401k Investment Club. Thanks, guys, for being on here. And we're going to get right into this. If I can figure out how to change the slide. So see here. I think there we go. Sorry. So why 401k? Jeff, you want to talk us a little bit about the contributions and the solo 401k program?
Absolutely. So you can do $55,000 annually contribution. You can be the trustee. You control the investments. You can be the debtor, and there's absolutely no administration fees.
Well, that is appealing. I know the self-directed IRA, there's a lot of hitches, especially when it comes to custodians. You don't truly have the power of the checkbook in those cases. And Austin, you want to talk a little bit about just the programs?
Right. Yeah. So 401k. I mean, a lot of people are looking to retire with those funds, and this is an excellent way with real estate to invest those funds. So many 401ks only make about 4 to 6% after fees, which is not very good. Financial planners use about 8 to 10% expected returns on their stocks, but with real estate, there's huge benefits and huge returns. It's almost unlimited, and yeah, a lot better than stocks, I believe. You can also be a lot more diversified as well.
Well, it is real comparative, obviously, with the 401k solo, where you invest in real estate, you can add equity, right? You can't do that to stocks. You have a lot of issues when you, pardon me, get to control over your investment. In the stocks, you don't have any control. Good luck trying to sell a stock when it's in a nosedive. But you can make 25 to 30%, obviously, with real estate, just because you can go in and you can obviously renovate or new build, new construction, split a lot, add value through rent increases, renovate the property, and obviously add value to each unit as well as the curb appeal. Multifamily properties have become very hot and continue to this day to be an attractive investment for almost all investors out there, especially real estate investors. And the value of these properties are not based upon comps of others. They are based off the cap rates, which I'm sure you'll have something to say about. Jeff, you want to talk a little bit about cap rates?
Yeah, so cap rates are a way for an investor to basically estimate their potential return on that investment. Typically, the lower the cap rate, the more valuable the property is. So when rents go up, the investment value of that property also goes up, and you base that off of the cap rate. Something in Denver here is around 5%. Something in Memphis, Tennessee is around 8 to 10%. So it varies from market to market.
Yeah, we have 2-3% cap rates here in Aspen. I know those C and D properties are what we're focused on currently. Most of our investors in our community, and why is that so appealing, Austin?
Yeah, C and D class multifamily is very appealing. Just because, Todd, I know in Denver the rents are skyrocketing, and no one can actually rent out a house or rent out an apartment without paying their full paycheck. So it's always going to be in demand because there will always be a demand for low income housing. And
I know that entry level is getting leaner and leaner for sure. And same with the middle class, right? Getting beaten out.
right. Yep. And yeah, homes are becoming unaffordable. So yeah, as that starts to happen more and more, which it will, then multifamily will be more demanding to rent out.
Well, we're definitely seeing it now, especially with that wall going up. And Jeff, what kind of strategies are you using out there with your 401k solo?
The 401k solo, we're taking it or using it as a self-directed, and we're putting it into the C and D property.
So
these properties typically need some renovations, and we can do some extra stuff to bring the rents up the market levels and increase the value of that property.
Just going in and renting, is there a specific target you'd like to share with the community? Statewide, like is it multiple? Is it countrywide, or are you focused in on certain states? Can you talk a little more about that?
We are pretty much across the United States. Where we're not really looking at heavily at is in the incredibly high demand markets. Something like Florida is really hard to invest in because everyone is down there investing and increasing the value of those properties and making it very difficult to invest. So we can do like Memphis, Oklahoma City, Alabama, Georgia. Those Midwest cities are really great targets for us to look at.
I got you. So a little more focus, not only on the little less than median, right? Median down to entry level is Austin what we're talking about. Is that correct?
That is correct. If we find something in Denver or Florida that looks great and works for us, we definitely would jump on it.
And I know we're jumping into, I mean, we've been focusing on tiny homes as well, RV parks, trailer home parks that we're now working towards gentrification and bringing them into the fold, as it were, with tiny homes or tiny home communities. I think this is going to be the wave of the future as well. But that entry level housing, those C and D properties, the tiny homes, the trailer parks that are being gentrified back in, well, not back into something new, something that's trendy, which is this tiny home trend that's going on. And I know we're heavily involved in that. I know Austin's heavily involved in that. But tell us a little bit about, Jeff, about obviously investing with your self-directed 401k. I guess you call it a solo 401k, not self-directed. Sorry, but the benefits are obviously the monthly income.
Absolutely. So these properties generate an income every month. So you're getting a check from the distribution of that profit. That is tax-free, put right back into your 401k, and you can use that on the next investment.
So compounding upon the sale of the property, going back in, deferred returns, compounding, obviously to build that nest egg. Is that correct?
Absolutely.
And the money from that 401k compounding over time, depending on how much time you have, obviously can be significant, if not exponential. So that's why we're involved in the 401k Investment Club. We hope this introduction has given you an idea of what we're doing and what we're investing in. Thank you so much, Jeff and Austin, for participating and being here. Well, thanks again, Jeff. Jeff, would you like to say any on the back end here of this video before we sign off?
I appreciate everybody for their time, and you can visit my website, bradenacquisitions.com.
Excellent. bradenacquisitions.com. Austin, thank you so much. Do you have anything, any final words for our audience?
Yeah, just really excited. Just the multifamily C&D is very, very appealing and very profitable, and we're really excited to talk more about it on the next one.
Excellent. Well, thank you, gentlemen. Thank you, everybody, for being on the webinar, and we'll see you on the next one.